Dear students, welcome back to the class. Can you hear me clearly?
Yes, sir.
Great. So how are you doing? Is everything fine? Is everything fine? Yamala. Yes. Okay. So great to know that you are doing fine. Today, actually, during the first part of the class, we will continue our discussion on the capital budgeting, the next part of our syllabus. Let me try to remind you about that. If you can you see the syllabus on the screen?
Sir, yes.
Okay, so we have already done so many things like the introduction, then Excel formatting, shortcut, graph, chart, lookup, index, match, formula, logic development, function. So these are the Excel basics that we have done during the first part of during the initial sessions. Then we have gone to the application of these spreadsheet basics, the spreadsheet software basics to the financial problem solving. So we have started with financial statement analysis using ratio analysis. So we have done in the class, and also the students, all of you have done practice during the class, and you have also submitted a case study. You have been assessed your group performance and individual performance. Then we have gone to time value of money, and we have also done that, the time value of money. After that, before you have submitted the case study on time value of money, we have also done cost of capital. I will show you again, just to remind you about that. Just have a very brief review: cost of debt, cost of equity, and all this thing. So then you have actually, by this time, you have submitted the case on time value of money, and now we are supposed to do the capital budgeting techniques case study. So today we'll be discussing that one. Okay, and I will also send you an assignment today, so that you can submit it by the coming Wednesday or Thursday. That will be based on the cost of capital that has been discussed in the class before the last class, and also today's class. Okay, so the case study will be like that. Today we are going to discuss the capital budgeting technique application in spreadsheet software. And of course, before that, we have to learn about different capital budgeting techniques. Okay, then we will apply that. Okay, and after that, some students who could not present before, they will get the chance to present or demonstrate their participation. And after that, we'll also discuss about the final exam. You have your final exam, upcoming final exam. So I will let you know how the final exam will be structured, what type of questions will be there, so that you can get prepared for that. So have you understood what we are going to do today?
Yes, sir.
Okay, that's great. So let's start with the capital budgeting techniques. This is your book for theory, for the concepts. So in this book, if you go to the table of contents, you will find that we have under part 5, we have chapter 10. Okay, that is actually for capital budgeting. So before we, because this course is basically focused on software application, but before applying the concepts in the software, you need to have the basic idea what capital budgeting actually is. So what we will be discussing here is not very comprehensive, rather very straightforward and precise. We will discuss about several capital budgeting techniques that are very useful for making investment decision. Number one will be net present value 10.3. Okay, then we will discuss about internal rate of return. Okay, internal rate of return. These two are the very important capital budgeting techniques every business graduate should know. Okay, we will not go into the theoretical details like comparing the NPV and IRR, then comparing. So these are basically theoretical part, because your course is mainly focused on the application. So we might not cover that, and also some other very strictly theoretical things. We will not include that. But we have to know what is NPV, what is IRR, and how to calculate the NPV and IRR so that we can make an investment decision. So that is very important to know. So I'm going to do that. I'm going to open my notebook so that I can help you to understand what actually the capital budgeting is and how the NPV and IRR techniques are used for capital budgeting. Okay, so can you see my notebook?
Yes, sir.
Okay. So the thing is, we know that the business organizations collect money for doing their business, definitely, right? Can you still see the notebook? Hello?
Yes, sir.
Yes, sir.
Yes, sir.
Okay, so the business organizations collect fund for doing their business. Okay, and after collecting the fund, they also invest. Am I right or wrong? For doing the business, they will have to invest. So where do they invest? They invest in two types of assets. And normally they invest in assets. So what are the assets? Number one is the current asset. Current asset. And
Bro, I also want this notebook, bro. Where can I find this?
yeah, sorry, what did you say?
No, Ray, some other app it is. OneNote. I don't know anything, Ray. I don't.
Is she talking to me? Anybody can help me?
No, sir. Can you, sir, you can mute her.
Oh, okay. I think she can mute herself, no problem. It was accidentally. Okay, so you can see that actually the business organizations collect fund for doing the business, and they also invest the collected fund in different types of assets. So basically we can divide the assets into two types. One is the current asset, another is the fixed asset. So what do we mean by current asset? Current asset is the assets having life less than or equal to 1 year. And what is fixed asset? Fixed asset is the life that is greater than 1 year. So can you give any example of current asset? Anybody?
Sir, inventory.
Sorry, inventory, right? So inventory, it can be inventory. Definitely, current accounts receivable is also one example, and another one is inventory. This kind of things are in the current asset, and these are these assets normally are converted into cash within 1 year period. So what do we mean by fixed asset? So the examples of fixed asset, can anybody tell me any example?
Land.
Yeah, land is a very much fixed, right? Land. Then what else? Plant means factory or something like that.
Sir,
Okay, then
patent.
yeah, patent, equipment, okay, furniture, vehicle, etc., etc. So these kind of things are fixed in nature, because those assets will continue for a very long period of time with the organization, and they will help the business organization to generate cash flow for a longer period of time. For a longer, every asset will generate what? Generate cash flows. Am I right or wrong? If you have the asset will be used in the business to sell your product or service, and when you sell your product or service, you will get some cash flow. Okay, so the assets normally has different cash flow. Now, when the business organization invest in different type of assets, okay, how do they make the investment? How do they decide whether to invest in equipment 1? I'm not naming the equipment 1, or invest in equipment 2. Which one? In which equipment should be invested? In which equipment should be invested? It depends on the two things. Okay, one is the cost of the asset, and another one is the benefit from the asset. Okay, and how do you determine the benefit of the asset? By measuring, by identifying the cash inflows from the asset. So the more cash inflow is possible to generate by the asset, the more is the benefit. Do you agree with that? Do you agree with that or not? If an asset generates more cash flow, is it a benefit or not? Is it a better benefit or worse benefit?
Benefit, sir.
Benefit,
If
right?
it is
So
inflow, means benefit.
the more is the cash inflow. Inflow means cash coming in, the organization. Okay, let's say this is the business organization. So when cash is coming in, we call it cash inflow. Okay, we call it cash inflow. And when the cash is going out of the business organization, we call it cash outflow, flowing outside the organization, and that is inflow. Okay, so the benefits are actually measured in terms of the cash inflow from the asset. And what do we mean by cost? Cost is actually measured in terms of cash flow, cash not flow, cash outflow actually. If we say flow, then the question will remain, what type of flow? So actually it is going to be cash outflow. Okay, cash outflow from the asset. Now, what do we need to do? We need to compare how much cash is going out with how much cash is coming in, okay, then we'll be able to decide which one provides more benefit over the cost. More benefit over the cost. So this process, this process is done using a technique called net present value, or NPV. Okay, net present value or NPV. So how do you define net present value? Okay, net present value is equals to present value of, you have learned the present value in time value of money. Have you learned or not?
Yes, sir.
Present value of all cash inflows from the asset minus present value of all cash outflows from the asset. Got it? Got it or not? Hello?
Yes, sir. Yes, sir.
So what we are doing here, we are actually comparing the benefit versus the cost by deducting the cost from the benefit. And not only that, we are also applying the present value. Okay, we are applying the time value, because we know from our previous discussion that benefit today and benefit after 5 years is not equal. Okay, so what we need to do, we need to calculate the present value of all benefits and present value of all costs, then find the difference. Then it will be net present value. Now tell me, if the net present value is negative, what does that mean? Anybody, any answer? Wrong, right? No problem. If the net present value is negative, what does that mean? It means that the present value of benefit is more or less than the present value of cost.
Less, sir.
Less. Yeah, the benefit is less than the cost. So what we can say that if NPV, how we do the calculation, we'll discuss that later. But now see the logic. The NPV, if the NPV is less than 0, that means NPV is negative. So what does that mean? Less than 0 means negative, isn't it? So if NPV is less than 0 or NPV is negative, then what does that mean? It means that the present value of benefit is less than the present value of cost. We know, we can understand that from our very basic understanding of mathematics, right? So will you invest in an asset where your benefit, the value of benefit is less than the value of cost? Will you invest in that kind of asset?
No, sir.
Anybody? I think nobody, no rational person will do that, because if you do that, then you can clearly see that your cost is more than the benefit. And similarly, if NPV is greater than 0, then what happened? How do we see that? Then then actually it is also equivalent to say that NPV is positive. So if NPV is positive, what does that mean? It means present value of benefit is greater than present value of cost. So we should be happy, okay, with that, and we should be unhappy with the previous one, right? So for any investment, if we find that the NPV is positive or greater than 0, then accept the project, and then accept the project, then accept the project. And if we find that the NPV is negative, then reject the project. Do you understand that? Reject the investment. So this is the decision making, whether we should invest in a project or not. Okay, so if you find that the project is, a project has NPV, positive NPV, then you should accept, because it will give you some more benefit over the cost. And if you find that the NPV is negative, then you will reject the project without any doubt, because it will definitely give you more cost than the benefit. Clear or not?
Yes, sir.
Okay, now let's say we have a project here. Let's say we have a project here, and we have learned the cash flow timeline. Okay, so let's say the project, let us try to list the cash flows from the project. So we need the year 0, 1, 2, 3. Let us make it easy. And the cash flows. So at first, to start the project, project means investment. To buy the asset, for example, buying an asset is also a project, because sometime the asset will, the life of the asset will be over, and your investment project will be over. Okay, so sometimes we also call it a project, investment project. So these two are actually similar. You can call it an asset. You can also call it an investment project. So let's say we are thinking about an equipment, thinking about investing in an equipment. And if you invest in that equipment, from that equipment, your organization will receive following cash flows in year 0, 1, 2, 3. Year 0 is now. Now you will have to invest $500. I'm giving minus sign because that is a cash outflow. Cash outflow means cash is going out of the company. The company cash is being deducted because you have to buy the asset. And then from the asset in year 1, 2, and 3, you will receive this kind of cash flow, plus 20, plus 400, plus 100, 120. Okay, so this will happen during the 3-year life of the project. During the 3-year life of the project. Okay, now we can also show it on a timeline like this: 0, 1, 2, 3. So in year 0, how much should we write? Can you tell me how much should we write in year 0?
Minus 500, sir.
Minus 500, very easy. Then in year 1, it will be 20 plus. In year 2, it will be plus 400. In year 3, it will be plus 120. Now, you can clearly see that these 3 are the cash inflows, and this one is the cash outflow. So to apply this definition, what you have to do, you have to calculate the present value of all inflow and present value of all outflow, then find the difference. Then you will get the NPV. But the problem is, to calculate the PV, you need the cost, you need the discount rate. So what is the discount rate? Remember that the appropriate discount rate is always the weighted average cost of capital that we have learned in the previous class. Do you remember weighted average cost of capital? Do you remember or not? Oh, I said that I will help you to remember, right? So let me try to remind you. Do you remember this one? This weighted average cost of capital?
Yes, sir.
How much is the weighted average cost of capital here?
11.08%.
Yeah, 11.0. How did you get that? By calculating the weighted average from the debt, common equity, and preferred equity costs. And we have also done the calculation of the preferred equity cost, common equity cost, and the cost of debt separately. And then we have combined all these here, right or wrong? Combined all these here to get the weighted average cost of capital. So we have already learned that. Now these cost of capital will become the discount rate of the net present value calculation. Got it? Got it or not? Okay, so whenever you need to calculate the present value, you need the discount rate. So which one will be the discount rate? The discount rate will be the weighted average cost of capital. The weighted average cost of capital that we have already learned how to do, right? So in this case, for this particular asset, let us calculate the NPV. NPV is equals to present value of all cash inflows. So what are the cash inflows? 20 over, you know how to calculate the present value. The cash flow divided by 1 plus discounted to the power number of year for which you are discounting. Do you remember? Do you remember or not? Tell me.
Yes, sir.
So let's say the weighted average cost of capital is 10% for simplicity. Let's say the weighted average cost of capital is, we have found in another model that is 10%. So 1 plus 0.10 to the power 1, because you will discount it for 1 year. Okay, now plus 40, another cash inflow, divided by 40 or 400, divided by 1 plus 0.10 to the power how much? Who can tell me? 1 plus discounted to the power how much?
2, sir.
2, because we will discount it for 2 years. Remember, all finance concepts are interrelated. So if you forget, then it will not work. You have to remember, okay? Then the another last cash inflow is 120. So 120 divided by 1 plus 0.10 to the power 3. So this part is actually this portion, present value of all cash inflow. Now from here, we have to deduct the present value of cash outflow. Fortunately, in this case, we have only one cash outflow, so we don't need much calculation. And that is already in year 0. Okay, so it is already at present, so we don't have to calculate the present value separately. But for if you, in case, let's say you have a cash outflow in year 2, in that case, you have to do that as well. Anyway, let me do it in a format. So 500 is the cash outflow in year 0. So it will be 1 plus discount rate to the power 0. Because it is in year 0, and you'll also calculate it in year 0. So if you do this calculation, then how much will be the result? Please take your calculator and tell me the results. Each and every result separately. So here it will be 500 over 1, because anything to the power 0 is 1. Okay. So tell me what is the first, what is the result of the first one? 20 over 1.1. Are you doing it or not?
Sir, 18.18.
Okay. 20 over 1.1. Yeah, 18.1818. Okay, 18.1818. Then the second one.
0.57, sir.
Yeah, 33.
0.5785.
Good. Then the third one.
90.1577, sir.
90.1578. Then this one is 500. So what is the sum of cash inflow, present value of cash inflow, sum of these three? Do in the calculator. Minus 500. 500 over 500 is 500.
Sir, 438.9181.
Okay. 438.81
38.9181
minus 500. So ultimately, what is the result?
minus 61.081.
So our NPV is positive or negative?
Negative.
Huh.
Negative.
Hence, NPV is less than 0 or negative. Therefore, should we invest in this project or not?
No, sir.
We shouldn't invest in this project. Got it? Now let us try to do it in a spreadsheet. Can you see the spreadsheet file? Can you see the spreadsheet file?
Yes, sir.
Okay. So we have already done this weighted average cost of capital in the previous class. So we are going to use it as the discounted, because you know the discounted must be the weighted average cost of capital. So let us open a new worksheet and rename is at NPV, or simply capital budgeting. Okay. Now, let us give another example. Let's say equipment 1. Or it can also be any other asset. So let's write asset 1. Information for asset 1. So the information is initial investment let's say our initial investment is $10,000. Okay. And cash flow in year 1 to 3. For the first 3 years, the cash flow is going to be let's say 5,000. Cash flow in year 4 is minus 2,500. For some reason, it is minus. And cash flow in year 5 is equals to, again, 1,000. So if this is the case, then you can understand that The project has a heterogeneous cash flow, different cash flows in different years. So at first, what you should do, you should list the cash flows by year. Okay, so you can understand how many years do we need here.
6, sir.
Yeah, from year 1 to 5 years, and year 0 is the to represent the current time. Okay, that's right. 5 and 6. No, we don't need the 6 because it will be end in year 5. Okay, so these are the years. Now, cash flow. So if the information is there, you should actually, you should copy, you should not type in. If you type, then your marks will be deducted. Now, what you need to do, you have to link the cell. So initially, you should type the input information. Then when you do the calculation and generate the output, you always should link the cell where the information is kept. So if you link here, one problem is here the negative side is not given, but we can understand as a human being subjectively that because it is initial investment, that means it is actually minus. Am I right or wrong? Do you understand? Hello?
Yes, sir.
Do you understand or not?
Yes, sir.
So what I mean is, we human being convey information in different manner, but for machine we have to convert it into a standard format, right? So from year 1 to 3, the information as it is given, sometimes it might be given in a different manner as well. So we have to use our intelligence to convert it into a format that is that can be used by the software. So for year 1 to 3, it is going to be how much? It is going to be 5,000, and we can understand that is plus. And not only that, it is going to be fixed. So let us put a $sign before the row number, and let us copy it for 3 years, so that it does not change when we change the row. But for year 4, it is going to be this one, straightforward, because minus is already given. And for year 5, it is going to be this one. And because we are not going to copy these links to right or left or down or up, so we don't need any further adjustment. Now, how to calculate the net present value? How to calculate the net present value? What we can do, we can actually use a very straightforward function. Let me write down net present, or simply I can write NPV. NPV. The calculation we have done on paper is not necessary here because we have ready-made function from the spreadsheet software. So let us see which function we can use. If we use PV, then what is the structure of the function? It gives you the rate, the number of period, the PMT. So from this structure, we can understand that this function is not usable here. What is the reason? The reason is this structure, this function is meant to use for equal payment every month or every period. PMT represents the equal payment every period. So this function will not work. Which function will work? NPV. Because we often confuse with these two functions, in which case these two functions should be used. Okay, so you can see here we need the rate and we need different values of different year. Very easy. So what is the rate actually? The rate is the discount rate, and we have already mentioned that it has to be the weighted average cost of capital. And we have already calculated the weighted average cost of capital previously. So what we can do, we can link it from there. So let us click the worksheet where we have done the rate, then link the rate, then press a comma. Okay, now we have to find the values, and the values are in this worksheet. So let us go there and copy all these values. But there is a problem. You have to remember there is a limitation of this function. Actually, you should not take from year 0, because if you start from year 0, NPV function will think that this 10,000 cash outflow will occur in year 1, because Excel thinks that the cash flow start from year 1. This is why you have to rather take it from year 1 and then manually, separately add the year 0 cash flow. And that is not a problem, because year 0 cash flow is already at present. So if you just add it, that will be sufficient. Okay, so now we have 5 values for 5 years. We end the function and then we plus the year 0 value. So because already minus sign is given, that is not a problem. If minus were not given, then we could have adjusted the function. Anyway, because the cash outflow and already minus is given, so we plus it. So after that, we press enter and we get the NPV. Now we have got a problem with the format of the value, which is percentage. So what we need to do, we need to convert it into general or number, whatever you do, and also decimal point. You don't need that much. Okay, so now this is actually the net present value. Do you understand how to calculate the net present value?
Yes, sir.
Okay, that's great. So can you do that? So I'm keeping the screen open and I'm giving you about 5 minutes time to have your own practice in your computer. And after that practice, I might call you to show by sharing the screen. Okay. So the time starts from now. Okay. So anybody who wants to volunteer and show the calculation? No problem if you make mistake. I'm here to help you. No problem. So, Omar, are you interested? Am I audible to the class?
Yes, sir.
Hmm. Pradeep, are you interested to share your screen?
Yes, sir. Just wait, sir.
Yeah, please.
So just give me a second. Sir, can you see my screen?
Yes, yes.
Yes, sir. Sir, should I take the same values or the other values for calculating the NPV?
Yeah, you can use other values. That is even encouraged.
Okay, sir. So let me take the asset of 1. Let's take the initial investment investment of 20,000 and the cash flow for 2 years from 1 year to in a year of 1 to 2, let it be 1200. Then for cash flow in year 3 to 5, it be as minus 4,000. The cash flow in year 6 to 7, let it be 3,000. Here we are the different investment. We have the investment of 20,000, and there are also cash flows from different years like 1, 2, and 3, 5, and 6, 7. So let's find the NPV for the different and if let's find the NPV for this investment and the cash flows. Here the cash flow. So the first year is we'll consider 0 also as a initial installment investment is considered 0 year 0, and year 1, 2, 3, 4, 5, 6, and 7. So the total number of period of year is 8. The initial investment is of 20,000, and this will be negative as it is a cash flow out cash flow. The for year 1 it will be 1200. Let's fix the dollar signs for both. 4, 8. And for year 3 it is minus 4,000. 3, 4, 5. For 3 years it will be negative. It will be 4,000 for 3, 4, 5, 3 third year, 4th year, 5th year. And for the 6th and 7th year it will be up to 3,000. So let's take a discount rate of weighted average discount rate as 10%. Now the NPO for this investment will be as your formula will be NPV, and here the rate is nothing but discount rate for the weighted average thing of 10%, and the values are like we need to calculate from first year 1 to 7. I mean not including the year 0 like initial investment. So selecting all after closing it, like initial investment is of negative, it is in negative. It's like we are cash flow is going out, so we need to exclude it, like, and we will be adding by it out of the formula, and we got the 20,094 is the net present value. It means that it is negative, so the investment is rejected. That's
Yes. Okay.
that.
Okay, thank you very much. Yeah. Well, can you see my desktop? Hello?
Yes sir.
Can you can see the Excel file, right?
Yes sir.
Yes, sir.
Okay, great. So this is
Yes, sir.
how you can actually find the NPV of a project. Now, in this case, the project is actually you can also write down the decision like this one. You can use the if function that you have learned before. If this one is greater than 0, then what is the decision? Accept. Right or wrong? If NPV is greater than 0 means positive, so you can accept. Otherwise, reject. Close. And not only that, you can also use some kind of conditional formatting to make it appealing. Let us make it bold. Like for this one, you can that is something, you know, something a matter of your choice, and that is not a compulsion, but you can do something called new rule. There are different options: 2 color, 3 color, etc., etc. Anyway, let us use 2 color because we have either accept or reject. So if the value is accept, then let us make it green because green is a green signal, isn't it? And if the value is reject, then let us make it red. I hope it will work. I have never done it before, and it is not working. Anyway, we can also use this one. Contain cell specific text, containing accept. It should be green, greenish something like this. So let us see if we increase the initial investment to, let's say, very high investment so that the project becomes negative, NPV becomes negative. Yeah, it is working. Okay. So these are something that you can play around, I'm just showing you to encourage you to enjoy the
Yes,
spreadsheet.
sir.
Hmm. So not only that, there are so many other options, you can, this is not something that we should teach in the class. Rather, those who are enthusiasts, they will think about that. Like write, read, these are the formatting, then read text, red border, customize formatting different. You can play around all these things. So you can even spend a very long time with the conditional formatting. Anyway, so this is how you can actually mm, do the do work with the project decision. Okay, now let us do something additional. Let us think about another asset. Let's say we have another asset having following cash flows. Let me copy and change rather than writing again and again. So in that case, the cash flows are from year 1 to 5. All cash flows are equal. And the initial investment is 20,000. And weighted average cost of capital, that is always the discount rate. We have already got that. So in that case, how do you calculate the well, let us think that this project is actually a 6-year duration. 6-year duration and 4,000. I'm just changing the example. So you can use the same format actually. So let me write down and then I'll delete, no problem. This is the benefit of spreadsheet. Now I will delete this portion and do it again. So how many years do you have? 6 years. So I will add another year, and then cash flow is equal to minus this one. Then for year 1 to 6, it is the same. So we can very easily log this one using $sign and then copy. And because this is the same organization, so we can use the same cost of capital, no problem with that. And what I will do, I will actually copy this portion. If I copy this portion, then I don't have to do the conditional formatting again. Same labor will work. So Control V, but I will delete this one because I need adjustment here. So what to do? NPV is equals to, again, the function is NPV bracket starts. The rate is just like before, this one, comma. The cash flows are from year 1 to 6, then bracket close, then plus the negative initial investment. Is that okay or not? Please have a look. Now press enter. So you can see that in that case, the NPV is negative and the project is being rejected. Do you understand that? Hello?
Yes, sir.
Yes,
Okay.
sir.
So the reason I brought another asset is we also have to think about choosing among the alternatives. So let's say we have these two alternatives. We can do the analysis in different manner. One is just analyzing for one asset, either this one or that one. And another decision is if you have two alternatives, okay, then which alternative to take? In this case, definitely we'll take asset one. We'll invest in asset one because asset two is not investable. But what if asset two is investable? So to make it investable, I will change the example. I will reduce the initial investment. Let's say 15,000. Now it is positive. It has positive NPV and it is also acceptable. So now the question is, should we invest in both the projects? Should we invest in both the projects? What do you think? What do you think?
Sir, we will invest in second asset, sir.
Sorry? Sorry, what did you say?
In this case, we can invest in second asset, sir. Asset.
Why?
Because the NPV is more than the first asset's NPV.
Yeah, you are right. But remember, sometimes the alternatives are not like that. Sometimes if you have money, you can invest in both. No problem with that. Okay, so it is depending on the type of alternative. What type of alternative do you have? Let's say I'm offering you some drink, hot drink. So I have offered you, do you want tea or coffee? So what does it mean? Will you say that I want both? Normally,
No,
what
sir.
would you say? You will say, well, tea, or you will say coffee, but you will never say, normally you will never say that I want tea in one hand and coffee on the other hand. And normally people will not say that. Okay, so in that case, tea and coffee are mutually exclusive alternatives. That means if you take one, you cannot take the others. So you have to think what type of assets these are. For example, if you think, if your company is thinking about building some kind of communication between your warehouse and the factory building. So the one option is to construct a road and another option is to construct a railroad. So even if these two projects have both the projects have positive NPV, you cannot actually take both. Am I right or wrong? Am I right or wrong? Can the company take both the projects? The company needs a way to transport the things from warehouse to the factory. So would the company build both a road and also a railway, or the company will make one of these two?
One of them, sir.
One of this.
So in that case, the type of alternative is mutually exclusive. Okay. So if the type of alternative is mutually exclusive, let me separate this portion. If the type of alternative is mutually exclusive, then what is the decision? What is the decision? Take the highest NPV, or let me write in other manner, invest in one asset having the highest NPV. Got it? Got it or not?
Yes, sir.
Okay, now, if the project alternative is instead independent, that means taking one does not affect the decision about the other one. If the choices are independent, then invest in all assets having positive NPV. We need to correct the previous one, because we should also mention that highest positive, because we can never take the negative NPV project, even if it is a less negative. Do you understand? So if the alternatives are independent, then you have to invest in all assets having positive NPV. Do you get it? Do you understand or not?
Yes, sir.
Okay. Now let us go back to our notebook. So far we have discussed about the net present value method. Now we are going to discuss about the another one, another very crucial one, which is called IRR method. Which is called IRR method. That means internal rate of return. Internal rate of return. So what is the definition of IRR? IRR, you know that if you want to calculate the NPV, then NPV is equals to, let's say, cash flow of year one divided by 1 plus R plus cash flow. R is the discount rate of year two divided by 1 plus R whole square, and so on. All positive cash flow. N divided by 1 plus R to the power N. This is the present value of all cash inflow. Now minus present value of all cash outflow. CF1 divided by 1 plus R plus. And let me mark it and take if it is only plus positive cash flow. If it is only positive cash flow. So plus to indicate that it is positive, and take all that has negative cash flow. Actually, it should start with 0, because it is very common that there will be a negative cash flow in year 0. And normally we don't have any positive cash flow, because just at the time of investment you do not get the return. The return comes after 1 year or after several time. Some time has been already gone. Okay, so CF, this will be to the power 0. That means 1. Okay, 1 plus R to the power 1. No problem if you do not understand this equation. This is the same thing that we have already done. Okay, plus CF 2 negative cash flow 1 plus R squared plus all the negative. So this is the mathematical expression of net present value, and in this expression we use this R. This R. This R is the weighted average cost of capital. This R is actually the weighted average cost of capital. This discount rate is actually the weighted average cost of capital. So after doing the calculation, we have found that sometimes we get our NPV, sometimes the NPV is greater than 0. Sometimes the NPV is less than 0. And that depends on 3 things. Depends on the cash flow that depends on the number of year for each cash flow, and also that depends on the discount rate. That also depend on the discount rate. So if the discount rate is higher, if R is higher, NPV will be higher or lower? What do you think? What do you think? If you do not think anything, tell me, sir, I don't think anything. If the discount rate is higher, mathematically, what you can see, discount rate is in the denominator. Higher. The proof is, let us go back to what we have done and check if that is really true. Oops. So let us check. Let's say in this case, we have taken the, we'll press undo so that we come back to this one. So previously the discount rate was 11.08%. That is taken in this link, right? So let us hard type and hard code it. Let us, instead of 11.08, let us type 15%. Okay, 15%. Do you remember how much was the NPV before? Okay, undo redo will help. Previously it was 11,151 at 11.08%. When I change the discount rate to 15%, that means increase the discount rate, the NPV decreases. Do you understand that?
Yes.
Do you
Sir.
understand what I have done? Just to show you that,
Yes, sir. Yes.
if we increase the discount rate, then the NPV will reduce. If we increase further, let's say 25%, now it is negative. So there must be a rate in between this 15% and 25% that will make the NPV zero. Right or wrong? When we are increasing the discount rate from 11% to 15%, it has gone down. NPV has gone down from 1100 to 400. Then again, from 15% to 25%, then it has become negative. So there must be a discount rate between 15% to 25% that will make the NPV zero. Am I right or wrong? Am I right or wrong?
So can you repeat the question once again?
When the discount rate was 11%, NPV was 1,151. When I reduce the discount, increase the discount rate to 15%, it becomes 400 only, reduce. When we further increase to 25%, it becomes negative. So can I say that there must be a discount rate between 15% and 25% at which the NPV is zero? Can I say
Yes,
that?
sir.
Because how can it be negative without being zero? Because it is gradually decreasing, isn't it? So from positive value to negative value, if it wants to go from positive value to negative value, it must cross the zero. So there must be a discount rate at which the NPV is zero. That is my point. Do you understand that?
Yes, sir.
Okay. So this is the point. This is the point. So there must be a discount rate. So we can say that the discount rate at which NPV becomes 0. It has a special name. It's called internal rate of return. Or IRR. Okay, so if we can calculate the IRR, that will give us what is the rate of return from the project. So how do we decide? Do we want higher rate of return or lower rate of return from an investment? What do you think?
Higher rate of returns.
Yeah, we always want higher rate of return. So investments with higher IRR are more attractive. Okay, investments with higher internal rate of return are more attractive. So if we somehow can calculate the IRR, then we can actually rank the project. The project with a greater IRR will have more acceptability, and the projects with lower IRR will have less acceptability. But remember, IRR is the rate of return. So it must be greater than the cost of fund. Okay, so cost of fund is, we have already mentioned. Cost of fund, we have already discussed that in previous class. Fund or capital that we are investing is the weighted average cost of capital, and rate of return is IRR. So what should we be careful about? Should not we compare these two? Should not we compare these two when making a decision? Should we compare or not? This is the cost and this is the return, means profit. So should we compare the cost and profit or not?
Yes, sir.
We should compare before we make the investment. So we should always make sure that the rate of return is greater than weighted average cost of capital. This is the decision criteria. Just like NPV, in case of NPV must be positive. So the criteria that must be satisfied is internal rate of return must be greater than weighted average cost of capital to accept the project. Accept any project, any investment project, any investment project. Got it?
Yes, sir.
So we will come back after the break and see how we can calculate the IRR and make the project decision in the spreadsheet software. And then we'll also do the presentation or demonstration of the previous case study. And we'll also talk about the final exam structure. So we can come back at, what is the time in India now?
10:55,
11.
sir.
In India, it is right now. What is the time?
It's 5 minutes to 11. 10:55.
10:55. Okay, we will join at 11:25. Okay. Is that okay?
It's 11:30.
Okay, 11:25 is the target. If you cannot achieve the target, don't cross 11:30.
Okay, sir. Thank you.
You're welcome. I hope the students are back. Can you hear me?
Yes, sir.
Yes, sir.
So what can you see on the screen? Hmm? What
Sir,
do you see?
Excel files, sir.
The Excel file, right? So just now we have discussed about the IRR, this one, right? So we have discussed about what IRR is and how IRR can be used for making an investment decision. So the criteria is the higher the better. IRR should be higher, that is better. But remember, IRR must be greater than the weighted average cost of capital. Sorry, just a second. Sorry for the interruption. Okay, you can see that the IRR must be greater than the weighted average cost of capital. Okay, so we are going to apply that for these two projects. So let me do it here. Is it okay if I do it here? Is it okay or not?
Yes, sir.
Just separating in my own way. Anyway, so what I am going to do, I'm going to calculate the IRR of asset 2 first. So I'm not going to repeat all this thing, just copy and paste here. Okay. And what we want to do is we want to calculate the IRR. And we'll also make decision definitely. Maybe we can copy this one, then we can adjust. That is a very good strategy, in fact. And we can also copy the format from here. These are my personal way, how I do all this thing. Now how to calculate the IRR. Okay. So here, you know that we, of course, will use the equal sign for starting with the function. Then IRR, you can see we have a ready function called IRR. Okay. So under IRR, we have only one thing to include, that is values, and also gaze. Gaze is not necessary. We just select the values and then we should get the IRR. If we select that and then close the bracket, then why it is not coming? Oh, sorry. Let me do it again. Selecting all the cells, including the initial cash flow, and then close the bracket. We don't need to gaze, and that is not necessary. Then we press enter and we get that the internal rate of return is 0.15. We should increase the decimal point up to 4 to make it more precise. So 15.34%. We can also convert it into a percentage. So if we increase the decimal point, okay, 15.34%. So now I have already said that the definition of IRR is the rate at which that NPV will be 0. So just to test that, if it is really like this, let us calculate the NPV as well at this discount rate. Okay, just to test. I will not keep it here. So the NPV, we will do the NPV using the IRR and see if the NPV really becomes 0, and then it will be a proof that we are using the correct function. But you don't need the proof always, because this is a class and we are trying to understand the concept. So I'm trying to show you. So as you know, it will be NPV, then rate is this one, then comma, we need the values other than the 0. Remember, in NPV you don't take the value of year 0, but in IRR you take all. Okay, close, then plus the negative investment, negative cash flow of year. So let us press enter, and you can see it is actually 0, very close to 0. You cannot get precisely 0, but it is quite insignificant. So it is actually 4.18 times 10 to the power minus 11. So after 11 zeros, then you get 41836, something like that. So are you convinced that IRR function is working?
Yes, sir.
Okay, so let me delete this one. Or
Excuse me, sir.
Yeah, please.
Sir, can you show us the IRR formula again?
Yeah, no problem. Can you see it here? Very simple. Just IRR, then select all the values starting from year 0 until the end. Got it?
Okay, sir.
So the decision, remember, the decision is not like this. Okay, in this case, the decision function should be corrected. Accept reject is okay, but we have to compare the value differently. We have to compare the IRR because we have accept first. So at first, the condition that will result in accept. So IRR must be greater than what? Must be greater than what? Greater than what? Do you remember from our discussion? IRR must be greater than what?
0.
Can you see on the screen what is shown here? We have just discussed before the break. IRR is greater than what? What do you see on the screen? Do you see anything on the screen?
Yes, sir.
Yes.
So what do you see? If you do not respond, I will just leave the class. Very simple. And you will do your own. You'll have your final exam and your case study you will do on your own.
IRR need to be greater than weighted average cost of
Yeah,
capital.
IRR need to be greater than weighted average cost of capital. So what will be the condition here? The condition will be IRR to be greater than what? See this one again and tell me. IRR need to be greater than what?
Weighted average cost of capital.
Yeah, so where is that? That is in this worksheet, right? IRR must be greater than. So if it is greater, then accept, otherwise reject. So the function is okay. We press enter. And because it is 15.34% is greater than 11 point, we can check it. We can see it. It is really okay. So you can accept the project. In the same manner, you can do it for this project also. But there is a but. I'm going to tell you why. There is a but. So asset 1, now all these are okay, but we have to change this one to IRR. Then what will be the function? Remember, there is a but here. I will tell you later why. IRR, then all the values. Bracket close, enter. 0.18. 0.18 is the IRR. So the function will be, the decision will be equals to, if, this time I'm typing again, if the IRR is greater than the
11.8.
weighted average cost of capital, then accept the investment proposal, otherwise
Reject.
reject the investment proposal. Okay, so in this case also is, but remember, this estimation has a limitation. This estimation has a limitation. So that is highly mathematical issue, but remember that IRR has a limitation. IRR has a limitation. So what is the limitation? The limitation is, I hope you can still see.
Yes, sir.
Okay, so the limitation is, it might give you multiple result, mathematically, but it is not shown in Excel. And also IRR assumes that the interim cash flow, the 5,000 you get in year one will be invested in at the same at the IRR rate. Okay, at this rate 18.13. So this is something like cyclical, cyclical conceptual issue. But it might not be possible because you have got the result that the rate of return is 18%. But how do you say that it is confirmed that during the interim year it will also be reinvested in the same rate, where you are saying that the cost of capital is 11%? So if the IRR is 18%, cost of capital should also be 18%, something like that. There is a conflicting issue which we are not keeping in the scope of this course. You just need to know that IRR has certain limitation. This is why we should use modified internal rate of return in place of IRR. Okay, so in Excel, calculating this one is very easy. I'm doing it. Just copy this one and paste here. So when you make an investment decision, it is always better to use the modified internal rate of return. It's better to use modified internal rate of return in place of internal rate of return. Okay, so let us write down the heading as well. Net present value or EV. This is rate return or IRR, and this one is modified internal rate of return or MIRR. So how to calculate this MIRR? Very simple and easy. So the decision criteria remains the same, but remember, we have to correct it because when we have copied it here, it does not remain the same. You see, weighted average cost of capital worksheet J49, but it has become O49. Okay, so we always need to check if the things are okay. Anyway, so if you want to calculate the modified internal rate of return, let me delete this too, and also delete this too, and calculate the MIRR. So that is also IRR, but improved calculation of IRR. Okay, so how to calculate modified internal rate of return? Equals MIRR, no matter whether you use capital or small, same function will come. So now you select all the values. Okay, then comma, now you need the weighted average cost of capital. The finance rate, finance underscore rate, that is the weighted average cost of capital. You need to bring it in here. So select this one, then comma, finance rate and then reinvestment rate. So if you know for certain that during the interim years of the project, during year 1, 2, 3, 4 or so, you know what rate the interim cash flows will be invested, then you can use that. But normally it should be the same. It should be the weighted average cost of capital. So normally it will also be the weighted average cost of capital. So I'm going there again and choosing the same weighted average cost of capital. So 2 times, you need to take this one 2 times and enter. So now it is a correct version of the internal rate of return, 13.19%. And now again, correct this one. Here it will be U15 is this one, that is okay. Should be greater than the weighted average cost of capital to accept the project. Okay. Let me delete also. So MIRR, doing it again, equals MIRR. The values, comma, finance rate, reinvestment rate, both are the same. This one, comma, this one. Bracket close, enter. Now decision is just like this one. So we can also copy this one here. But make sure, check it again. U30, weighted average cost of capital, J64. Let me check. U30, okay, U30 is okay. U30 and weighted average cost of capital, J64. Look, it is not 64, it is 49. It has taken something below this one. So we need to correct it. So never blindly copy. So this one has to be corrected. It must be greater than this one. Okay. So this is how you can actually calculate the MIRR. So what we have learned the 3 tools of capital budgeting. One is the net present value, another one is the IRR, and another one is the MIRR. But MIRR and IRR is conceptually the same thing, only difference is MIRR is a better measurement compared to IRR. So when we make practical decision, we should always use MIRR. So to keep all these things side by side, let me cut this and paste this here. Delete. Okay. So this is just theoretical discussion. Now, what we will do for making the ultimate decision, I can see that all are acceptable anyway. So to make ultimate decision, we can create a table, project or investment, then the tool or technique of capital budgeting. So investment will be asset 1 and asset 2, isn't it? Asset 1, asset 2. Asset 1, okay. Let me do it in this manner. Asset 1, asset 2. And this one is technique is NPV, then IRR, then MIRR. We also need the cost of capital. WACC, because we need to compare. So NPV is equals to, for asset one, the NPV is equals to this one. Asset two is equals to this one. This is just a summary. It is always useful to have a summary table. Irr of asset one is this one, and asset two is this one. MIRR of asset one is this one, and MIRR of asset two is this one. And weighted average cost of capital in every case is this one. Okay. Now, what we can do? Make a decision. Yeah. Decision. So there are two types of decision. One is if mutually exclusive, and if
Independent.
yeah, independent. Writing in short because we don't have that much space there. So the decision will be based on the NPV criteria equals if actually at first you have to make another thing, acceptable or reject. Actually, there is no standard format. This is what I'm doing by myself. You can also have your own framework, no problem with that. So I'm summarizing in my own way, just to give you an example. When you become a professional manager, you might have a better way of presenting the things. So by acceptable, what I mean is it acceptable at all or not? Then we will make the decision if mutually exclusive or if independent. Okay, so here it is very simple. If NPV is greater, and we need the acceptable for both actually. So let me insert. For the simple criteria. So whether acceptable or not equals if this one is equals if this one is greater than 0, then yes or no? Yes. Otherwise,
No.
Something like that. So we can actually straight away copy this one here, no problem. We can also check if T12, this is T12, right? So it is okay. You should always check when you copy. Now in this case, it is equals to if this one, oh my God, I'm making, if this one is greater than which one? This one.
SEC.
Weighted average cost of capital, then yes. Yes. Otherwise, you can have your own style. There are so many infinite number of ways of playing around. And MIRR also same thing, but should not blindly copy. Equals if this one is greater than the weighted average cost of capital. Otherwise, no. and this one not relevant. We can copy this 3 as well. It should not be a problem. Okay. So now what if these are mutually exclusive? So in case of mutually exclusive, at first, that is, sometimes it could be possible using formula, but I will prefer, because it's a simple summary, so I will prefer to use just subjective comparison. So you can subjectively compare, because both are positive. Given that these two are positive,
Asset 2.
you can actually use the logical function like and or something like that. You can also do that using the logic. You can place two condition. Let me try. If this one is greater than 0, I'll show the example only for one, not for all. Okay, if this one is greater than 0, and before that I have to press an and that means both conditions must be satisfied. If this one is greater than 0 and also this one is greater than this one. Okay, so if these two conditions meet, then what will be the result? Bracket close. So if this condition is true, then except 1, I'll just write 1, except 1. Otherwise, you need to have another condition actually for the second one. So sorry, it has to be here. Nested if, okay? If same thing, and if this one, now we're targeting asset 2. If this one is greater than 0, and also this one is greater than the other one, if this condition is fulfilled, then except 2. In this case, we will write except 2, or you can also write except asset 2. Okay, now press comma. So I think these two are the conditions when when either one of these two are positive, either one or both are positive. So if these two condition does not fulfill, then there is only one condition, that is both are negative. Okay, so in that case you can type reject all, something like that.
Where you didn't mention except 1.
Yeah, I have mentioned. Oh, I didn't mention. Okay. Thank you for correcting here, right? Now I think it is okay now. Do you understand? So we have to close all the brackets. So how many first brackets are there? 1, 2. So we have to have another one. Let's see. Probably there will be an error. No, there is no error, so it's okay. So let us check now manually. Asset 2 has greater NPV, so it's okay, right? Do you understand? No problem if you do not understand. That is just for just something like bonus material in your final exam, or in your final exam you are not going to face this conditional argument. That means not this logical argument like and, but you may face if and nested if. That is okay. So at least you have understood how we can actually use the function for even complex argument. Have you understood or not?
Yes, sir.
You can make a complex argument using nested if functions. So you can manually type for the other decisions. I'm not going to type all the I'm not going to use that kind of statement. So we see that IRR in both cases are greater than yes. So we have already done it, but because this is mutually exclusive, so which one should we accept? One.
Set 1.
Accept one. Now MIRR, it shows that
Except 2.
yeah, except 2. Okay, and if independent, then what happened? We can see that in all cases, all are good, except all, something like that. So this is how actually you can decide about the projects. Understood or not?
Yes, sir.
Okay, now that is all about our discussion. Now some students are expecting to present the last case today, but before that let me tell you that I will send you the third case by today in our WhatsApp group and also to the class representative. So you will find it in the WhatsApp group and also in the class, and you will have to submit it by Wednesday, and that will be based on our weighted average cost of capital, this one. This one, and about the capital budgeting, you have to you can expect it in the final exam. Actually in the final exam you'll have everything. So the reason I'm saying that you can expect it in the final exam is it has not been tested yet, so you can really expect that, but no guarantee. Can you see my screen? Probably no, right? Can you see my screen?
No, sir.
Okay. So now I'm going to call some students. Okay, who are there have not could not present in the last class. I have called but could not present because they were not present or had some health issue or something like that. So anybody like that? Anybody like that?
Sir, me.
What is your from which group? From which group? What is your group number?
Sir, group 4.
There is no group 4 actually. It is something like ABCD.
Sir, group E.
Okay, group E. What is your name?
Ojasvi.
Serial number?
5050.
50.
Yes, sir.
Okay, Ujasvi. Okay, so yeah, please share your screen and so that I can ask you to do something.
Yes, sir. Just a minute.
And the other students who were called in the last class but could not present, please also come forward.
Sir, the Wi-Fi in my hostel is very bad. I just need 2 minutes to connect to my friend's hotspot. Is it okay if you give me
Okay,
2
do
minutes?
that. Already 30 seconds has gone. Okay, any other student?
Sir, I'll do so.
Okay, Badri, please come forward.
Sir, I'll present after Ojasvi, sir.
Okay, Badri, please come forward. Which group, Badri?
Group 2, sir.
Group?
2.
Sorry, I don't understand.
Group B, sir.
B. Serial
Yeah.
number?
Sir, 81, sir.
81. Okay. Actually, Badri, you know, you do not need to present today. Okay, it's fine.
Okay, sir. Thank you.
Then who else? Anybody else? Who wanted to present after just sorry.
Yes, sir. I would like to present after Ojasvi, sir.
Okay, after. Okay. Anybody wants to present now before her?
Excuse me, sir.
Yes.
I would like to present next.
Okay, so you can start now. What is your group number and serial number?
Sir, my group number is G. I need 2 minutes, sir.
Oh,
Like
you
there's
also need 2
problem
minutes.
with my device.
Sir, may I start? Ojasvi.
Yeah, please. It will just be
Yes.
your group is E and serial number 50, right? Okay.
Yes, sir, correct.
Yeah, please.
Sir, is my screen visible?
Yes, it is visible.
Yes, sir.
Okay, delete the. Can you make it a bit bigger?
Yes, sir, sure.
Yes. Okay. Can you delete the delete? Okay, go up. Do not
Sorry,
move.
sir.
Yeah, stick here. So delete from cell number E10 to E13.
E10.
E10 only. E10, E12, and 13.
Okay, so one by one.
Yeah, one by one. E10,
Okay.
E12, and E13. No, delete all first. Delete
Okay, okay.
E10, delete E12, and E13.
Yes, sir.
E13 also.
Sir, I did it. Oh, sorry. Okay. Shall I start?
Yeah, please.
Done, sir.
Okay, thank you very much.
Should I stop screen sharing?
Yeah, please.
Thank you, sir.
Now, who is the next?
Sir, I'll do it next.
Okay. Akshara. Your group number and ID number, serial number. Akshara, your group and serial number.
1 second, sir.
Yeah.
Sir, I'm from Group D, sir.
And serial number?
83.
Okay, please continue. Oh, okay. Akshara, you don't need. I'm not going to take your presentation today. Get ready
Okay,
for the
sir.
next one, okay?
Yes, sir. Thank you.
I'm not calling everyone. There is a criteria for that.
Okay, sir.
So next one, after Akshara, who wanted to present?
Sir, me, sir. Rishita.
Rishita, okay. Your group number and serial number.
Group number G, sir. Serial number 12.
Serial number 12.
12.
Rishita, okay. You can present. So delete the year one opening balance to closing balance. Month one, sorry. Yeah. Now do it. You need to say what you are doing. It is not just typing. You need to speak out.
Yes, sir. So the loan amount is the opening balance, that is $10,000.
Your mic is off.
Sorry,
Please-
sir. So the payment,
Please do not switch off your mic during presentation.
sorry, sir. So the payment will be opening balance into interest rate. And principal is installment done, sir.
Okay, thank you. Who is next?
Sir, can I present next?
Your group number and serial number.
Group H, 31, Ravali.
31. H31. 31, but I don't see anyone. Okay. Sorry. Yeah, you can present.
Yes.
So delete the month 1 and month 2 values.
Month 1 and
Month 2, both. And then do it again. And also when you do it, do not switch off your phone, mic, and
Yeah.
also discuss, present, talk what you are doing, explain.
The beginning balance of the month 1 is the.
Also month 2.
Okay. The beginning balance of the month 1 is the loan amount. And the installment is the monthly equal installment, which we calculated through PMT. And the interest payment is just a second. Beginning balance into the interest rate, that is beginning balance. This is the remaining balance for the first month, and the second month's beginning balance will be the remaining balance of the first month. That will be 9757, which is H18. And next installment will be the same thing, which we calculated through PMT. And the interest payment is
Okay, Ravali, thank you very much.
Thank you.
Anybody else want to present now?
Can I go next?
Praharsha, what is your group number and serial number?
The group D, my roll number is 019.
0?
19.
Group number B.
Group number D, sir.
Okay, your name is Praharsha.
Praharsha Bhim Reddy.
Okay, yeah, please share your screen. Please do not leave anyone because we will be talking about the final exam.
Yes, sir.
Please delete. What did you do? Okay. Please delete the delete cell number H4. H4 and H5. What happened?
Sir, can you repeat again?
At first, share your screen.
Yes, sir.
Now delete H4 and H5. Now do it.
Yes, sir. So the formula for monthly payment is PMT, that is interest rate, maturity of the loan, comma 0, comma 0. Interest rate, loan amount, comma 0, comma 0. So 1 second.
You should not keep your mic off during the presentation.
Sorry, sir. Just little confused, I'm doing it. Yes, sir.
Yeah, the structure is okay. But by the way, have you done it alone or with your group?
I did it with my group, sir.
But I did not see any other member of this group having the same structure. Group D, anybody present yesterday?
So this is my,
yeah. Yeah, Praharsha, what are you saying?
sir, this is our group D Excel sheet, sir. We even shared this only with you. I downloaded.
Sir, I wanted to present, but you told me not to, sir. Akshara, I asked you that I would like to present after Ojasvi.
Okay, in the last class, anybody from group D presented?
Group D's Excel sheet, sir, because I just downloaded it from my
From where? From where?
Sir, that is our Excel sheet, sir. What she meant was last time some people couldn't do it because there was some Wi-Fi problem, sir. And I wanted to do it today, but you told me it's not necessary. So
It's fine. It's fine. What about Saiteja? Saiteja, are you there? Saiteja Vemulapalli, serial number 25.
Sir, is it right? Can I stop sharing the screen?
Yeah, you can stop sharing, no problem. So Saiteja Vemulapalli, are you there? Group D, what about Saiteja? Yeah, I can see her. She is in the class. Saiteja, your mic is off.
Sir, hello.
Yeah.
My laptop is not working. In last class, I already presented, sir.
But your file was a bit different from this one. Am I right?
No, sir.
Was it the same?
Yes, sir.
Sure. Okay.
Yes.
Okay, it is just I was thinking like that. Anyway, I can see that your worksheet is has used some function that we have not discussed in the class. So how could you learn that? From where did you learn that in your group? Group D.
Yes, sir.
Okay, who is the most capable in Group D?
Rohit Elitam and Tej Vishwa, sir.
Rohit Elita. So where is
Elitam
Rohit?
and
Elitam.
Tej Vishwa.
So can he or she share the screen and explain to me how this has been done?
I think they are not in the class. They're sick, sir. They went home.
Not in the class?
No, sir. They're sick. They went home.
Anybody of you are confident to explain the workings of this worksheet? Anybody else in this group? So who wanted to present, but I said no, not to present? Akshara, right?
yes, sir.
Okay, Akshara, can you share your screen?
Yes, sir. 1 minute, sir.
Yep. I'm going to take 2 or 3 minutes extra from you, if you don't mind.
Sir, can I get 2 minutes, sir? Because I'm on my phone, sir. I'll log into my laptop because you told me it's not
Okay.
necessary.
Okay, Group D, I will talk about that in the next class. So,
okay,
so now about the final exam. Now about the final exam in the, can you hear me?
Yes, sir.
Okay, now about the final exam. I think you can see one worksheet. So in the final exam, you will have 3 types of questions. One will be a small, very short question. That is conceptual question, carrying maybe 2 marks. Okay. Marks for each question will be 2, and number of question will be 5. So total, how much? Do you understand? How much total?
10.
10, exactly. Okay. So the 10 marks will be short question, like very simple questions. You have to type that the answer of the question in the Excel worksheet. Okay. And another type of question, it will be it will not be it will be something like small spreadsheet problems. Small spreadsheet problems, small problems, something like that. So for every question, and number of question is 5. So it will be 20. And the other one will be one case study, one spreadsheet case. So one spreadsheet case, so it is it will carry 10 marks, and number of question will be 1. So you can see it will carry 10 marks. So ultimately, can you hear me, students? So total
Yes,
how
sir.
much?
40.
40. So you have got the idea, right? Hello?
Yes, sir.
Any more question? So by spreadsheet problem, we mean you have to solve this in Excel. By spreadsheet case, we also mean you have to solve this in Excel. By short question, we mean you have to write in 1 or 2 sentences. Because it is online, so you will also write that in Excel worksheet. So I will show you in the next class in detail how to formulate, how to design the answer script in Excel file. So that's all for today. I will see you in the next class on Friday, and today you will get the 3rd case study. You'll have to submit it by Wednesday, coming Wednesday. Thank you very much.
So,
Anything else
excuse
you want
me,
to?
sir.
Yeah, please.
So when can we know the marks for our case studies?
Okay, after submitting the next case study, that means, and after demonstration and presentation on Friday, then on Saturday you will be able to know the marks.
Okay, sir. Thank you.
Because I cannot complete, because it has 2 components, group component, individual component. Until I get everyone's presentation, I cannot complete the mark.
Yes, sir. Okay, thank you.
Okay, thank you very much.